Hey everyone, welcome back to Pods and Ears. I'm Rob, and if you've been following along, you know we've spent the past few months really digging into data unification for grain elevators. We've talked about the hidden costs of silos, walked through practical roadmaps, examined how understanding share of production can completely transform your relationships. But today, we're tackling the question that every CFO and board member eventually asks: what's the return on investment, or ROI? And here's the thing. The answer really depends on whether you're measuring the cost of doing this work or the cost of not doing it. Let's dig in. So, most grain elevators approach technology investments the same way. You calculate the upfront costs, you estimate some time savings, and you hope the math works out in your favor. Here's what that calculation typically looks like. On the investment side, you've got Microsoft Fabric licensing, maybe $6,000 to $30,000 annually, depending on your user count and capacity needs. Implementation services, probably around $5,000 a month. Staff training time, and ongoing support costs. Then on the benefit side, you estimate that your accounting department will save 10 hours per month on reconciliation. Management saves 5 hours a week on report generation, and you'll have reduced errors in data entry. Someone runs these numbers and concludes it'll take 18 to 24 months to break even on time savings alone, and at that point, the project often stalls because the ROI feels marginal. But here's what I want you to understand. This calculation misses the entire point. Data unification isn't about making your accounting department slightly more efficient. It's about fundamentally changing what decisions you can make and how quickly you can make them. Let me share a story from my time at one of the major grain companies I used to work for. We had a producer, and we'll call him Jim, who consistently delivered about 50,000 bushels of corn to us each year. Good customer, reliable. We thought we knew his operation well. Then someone ran an analysis connecting our grain data with third-party acreage information. Turned out Jim was farming 3,200 acres and producing somewhere around 600,000 bushels annually. We were getting less than 10% of his production. Now, think about the math nobody was calculating. If our gross margin was just 15 cents per bushel on the grain we were handling, we were making about $7,500 from Jim annually. But if we could increase our share of production from 10% to even 30%, that's an additional $22,500 in gross margin from one customer. Now multiply that across your entire customer base. How many Jims do you have? And here's the thing. You can't know without unified data showing both what you're receiving and what's being produced in your draw area. That's not an ROI calculation. That is a business transformation. When you're evaluating data unification ROI, I want you to think in 3 distinct categories: operational efficiency, revenue growth, and strategic positioning. Let's start with category 1, operational efficiency. This is months 1 through 6. These are those traditional time savings benefits that actually do show up pretty quickly. Scale ticket reconciliation moves from taking days to taking hours. Your month-end close happens 3 to 5 days faster. Error rates drop by 60 to 80% through automated validation. Your staff time gets redirected from manual data entry to exception handling, which is much higher value work. On the management reporting side, market share analysis that used to take 20 hours per month now takes 5 minutes. Customer segmentation goes from quarterly guesswork to real-time dashboards. Performance tracking moves from spreadsheet chaos to unified dashboards and reports. And customer service improves dramatically. Contract lookup time drops from 5 minutes to 30 seconds. You have access to complete customer history during every interaction, and you eliminate those "let me check and call you back" moments. Realistically, most grain elevators save 15 to 25 hours per week across their team within the first 90 days. At a blended rate of $35 an hour, that's $27,000 to $45,000 annually in recovered staff time. That alone covers the cost of the technology investment. But again, that's the least interesting return. This is where data unification starts changing your business model. We're talking 6 months 6 through 18 here. Remember that number 14 customer from last month's newsletter? That wasn't unique. When grain elevators finally see their true market share and share of production data, they consistently discover a few things. 15 to 25% of their best customers are actually their biggest missed opportunities. 30 to 40% of producers in their expanded draw area have never contracted a single bushel. And their average share of production with existing customers is often below 40%. Now, it may be higher for a co-op, but even then, some farmers will sell directly to another processor or export terminal when they can get a higher basis level, especially in today's lower margin environment. So let's talk about conservative revenue impact. Say you're a cooperative doing 10 million bushels annually with a 15 cent per bushel gross margin. That's $1.5 million in gross margin. If you increase your volume by just 10% by focusing on share of production opportunities with existing customers, not even new customer acquisition, that's an additional $150,000 in gross margin annually. And the math scales dramatically when you start identifying and pursuing the right opportunities systematically, rather than just hoping producers call you when they have grain to sell. Now, customer retention matters too. How quickly do you notice when a longtime customer starts trending down? When a producer who normally delivers 80% of their crop to you suddenly drops to 40%, what's your early warning system? Most elevators don't realize they're losing a customer until the relationship is already gone. And by then, winning them back is exponentially harder than retaining them in the first place. Unified data gives you leading indicators, not lagging confirmations. You can have proactive conversations like, "Hey John, I noticed you haven't been in as much this year. Everything okay? What can we do better?" That conversation might save a $200,000 annual relationship. And how do you put an ROI on that? The long-term returns are the hardest to quantify, but potentially the most valuable. We're talking months 12 through 36 here. With real market intelligence, you start answering questions your competitors can't even ask. Questions like, which zip codes have the highest concentration of unserved production? Where should we invest in additional receiving capacity? Or does a ground pile during harvest for a particular location make more sense? Which customer segments are most profitable and growing? And what demographic trends will impact our business in 3 to 5 years? Think about competitive advantage for a minute. When a producer calls 2 elevators for a bid, what differentiates you? Price matters, sure, but relationship matters more. The elevator that knows the producer's delivery history, quality patterns, preferred logistics, and communication preferences is going to win more often than the one treating every interaction like it's the first time. And then there's risk management. Unified data reveals concentration risks you might not see otherwise, like discovering that 60% of your volume comes from producers over age 62, or that your 3 largest customers represent 40% of total volume, or that succession planning conversations aren't happening early enough. These insights don't generate immediate revenue, but they protect against catastrophic relationship losses. Let's get practical about the actual investment for a typical grain elevator operation. On the technology investment side, you're looking at Microsoft Fabric running about $6,000 to $30,000 annually, depending on capacity. Implementation services around $5,000 a month. Third-party data subscriptions, maybe $10,000 on an annual basis, depending on how many customers you have and how wide your drawing arc is. Training and change management, which is optional, but let's figure another $10,000 annually for that as well. So total 1-year investment, somewhere between $86,000 and $110,000. Now, expected returns in year 1. Operational efficiency from time savings, $30,000 to $50,000. Revenue growth from a conservative 5% volume increase based on improved share of production, $75,000 to $150,000. Customer retention, preventing the loss of 2 or to 3 at-risk relationships, anywhere from $100,000 to $400,000. So total year one value, $205,000 to $600,000. Even at the conservative end, you're looking at a 2 to 5 times return in the first year. And these returns compound as your team gets better at using the insights. But here's what the spreadsheet can't capture: the confidence that comes from actually knowing your business instead of guessing about it. Every month you delay is another month your competitors might be gaining ground. It's another month of relationship erosion you can't see. It's another market share opportunity you're missing. The real question isn't whether data unification delivers ROI. The question is, can you afford to keep operating blind while your competitors gain modern business intelligence? Now, you don't have to do everything at once. I suggest that you start with your accounting data and basic market share analysis. Get that working, see the value, and then expand. The beauty of Microsoft Fabric is that it scales with you. Start small, prove the value, and build from there. The technology investment is manageable. The opportunity cost of waiting is not. Before we wrap up, here are a few quick data points worth remembering. Average payback period for grain elevator data unification is 6 to 12 months. Typical volume increases from focusing on share of production, 5 to 15% over 18 months. And time savings from automated reconciliation, 15 to 25 hours per week. And here's this month's key insight. The grain elevators asking, what's the ROI? Are asking the wrong question. The right question is, what's the cost of not knowing which customers we're losing and which opportunities we're missing and which competitors are gaining ground? Next month, we're going to explore practical AI applications for grain merchandisers and how to implement them responsibly within your operation. That's going to be a really interesting conversation. If you want to calculate your specific ROI, every grain operation is different. Your volume, your margin structure, your competitive landscape, your growth opportunities are all unique. We'd like to help you build a customized ROI model based on your actual business metrics. Now, you can reach us at info@innovativegrain.com or visit our website at www.innovativegrain.ai, and of course, connect with us on LinkedIn at Innovative Grain. Thanks for listening to Pods and Ears. If you found this helpful, share it with someone in the grain industry who might benefit from it. And I'll see you again next month.